Between 2016 and 2017, Kenya's exports grew by a paltry 3% to 594 billion shillings, while imports surged 20% to 1.7 trillion shillings, leaving a balance of trade amounting to 1.13 trillion shillings. This is blamed on the slim export destinations made up of 13 countries which account for 70% of total exports.
We cannot have production if we don't have possibilities of markets. There's been lots of work done on growing the domestic market, growing the regional market, but we have come to appreciate that the regional market and the domestic market is not going to be enough to spur the level of investment that we require.
Similarly, horticulture, tea, clothing and apparel, coffee and tobacco make up 56% of all exports.
AGOA has opened numerous trade opportunities for Kenya in the United States, but remains largely untapped, as we shall hear. Only about 170 products are being traded when we have over 6,400 tariff lines.
For a country seeking to increase output in the manufacturing sector to 15% in 5 years, policymakers say product diversification is a must.
We have been losing in the export market. That's a fact. Looking at our traditional export markets, we've not been gaining. Then we have also been, of course, not giving a lot of support to our local industries to be able to grow, and therefore that market is being taken by a lot of imports from particular countries. And we have therefore developed a strategy on how to deal with that.
Sectors that have been tipped could help Kenya grow exports by 25% over the next 5 years to 1.8 trillion shillings are manufacturing, agriculture, handicrafts, mining and petroleum, as well as trade in services, beating projected 1.7 trillion shillings in imports. Nonetheless, access to finance still remains a challenge as the government is urged to set up Export-Import Bank with up to 500 billion shillings in capital to finance export development, while banks increasing lending to 1.8 trillion shillings. The Kenya Trade Week ends Friday. Ronald Owili, News Hour Business.